Your iPad.
All righty, guys, we're going to go ahead and get chapter 4 kicked off. This chapter is very, very, very short. It's going to be covering taxes, retirement, and other insurance concepts. What I'm going to do, guys, I'm going to go through the definitions rather quickly. And at the end of this process, you're going to see how I will create a cheat sheet that will help you not only memorize, but help you understand some of these retirement accounts. First of all, let's go over terms that we are going to know or going to need to know. Earned income. Earned income is the type of income you earn or that you get from any salary, wages, commissions. Earned income is earned from money that you actually give up your time and you have to personally go work for. This is not income from investments, unemployment, or similar source of income. When you see the word FIFO, that means first in, last out. I'm sorry, first in, first out. That's going to indicate based off of how money is taxed versus when you invest it. The word gross income, this is a person's income before taxes or other deductions. If you got a job, you'll see your income, your gross income on your check stubs. Then the other term, LIFO, last in, first out. This is when principles applied to an asset management and life insurance product under which it's assumed that funds paid into a policy last in, first out. Again, I'll go into detail how that applies. Nonprofit organizations is an organization that uses surplus to fulfill the purpose instead of distributing the surplus to its own members. Policy endowment, that means maturity date. We've kind of covered that in chapter 2 as far as maturity date. Pre-tax contributions, this is money that is invested this is money that is invested into retirement accounts prior to being taxed. Rollover withdrawals are money that is from one qualified account to another. I will give you definitions and I will give you simple real life concepts of that. Surrender, early termination of a policy by a policy owner. So someone that cancels a policy or cancels an insurance contract. The word vesting. This is the right of a participant in a retirement plan or retains part of all benefits. Vesting, that is generally attached to a job. You will have vested interest, meaning that an employer will give you vested interest in their retirement accounts. Generally, that's over a period of time. Tax deductible, that is the reduction of taxable income to result in lower taxability, which means you lower your income. You have tax write-offs to lower your tax bill. Taxable, subject to taxation, payable to state or federal government. That is just saying that what's going to be taxed. And generally, taxable income will come from interest. Tax deferred, that is when taxes on investments or gains, such as interest, dividends, are paid at a future date instead of the period of time which they are incurred a tax. Those are the definitions you are going to need to know, but I'm going to give this stuff to you very simple. Third-party ownership is when some insurance companies own policies on their employees, and the employer is the owner of third-party ownership. Generally, this is where what's the word we just went over? Assignment, where the transfer of ownership would come into place, a third-party ownership. If you guys remember, and what we talked about in one of the chapters of the terminal illness rider, when a person has 6 months or less to live, they can get a certain amount of money advanced to them. Those were the living benefits. This is where that is going to come into place. There is something called a biatical settlement. A biatical settlement allows someone with life-threatening conditions to sell their existing life insurance policy, use the proceeds when they are most needed before their death. While biatical settlements are not a policy option, they are separate contracts in which the insured sells the death benefit to a third party at a discounted rate. There are several important concepts that you need to understand about biadical settlements. The insured is referred as a biadder. So these are definitions you need to know. The insured is known as a biadders. Biadical settlement providers means a person other than the biadder that enters the biadical contract. Biadical producers represents the providers. Biadical brokers represents the insured. Just simple definitions you need to know. Biadders usually receive a percentage of the policy's face amount or face value or death benefit from the person who purchased the policy. The new owner continues to maintain the premium payments and will eventually collect on the death benefit. Wonderful. Hope you understood that. I'm going to give it to you in layman's terms. A biadical settlement is a contract. You have a third party company, which is known as the biadical provider. This is the person that other than the biadder. So the biadder, which is the insured, and the biadical provider, which is the company, they come together, and the biadder has life-threatening illnesses. And they need some money now. So they're going to sell their policy. So let's just say they have a $100,000 policy, and they sell the policy for $70,000. So they're going to sell that policy for $70,000, and that provider is going to continue to make the payments. So when that biadder dies, the biadical settlement will receive the rest of the money. So in return, that they're actually going to profit right around $30,000. So you sell your policy for a lower amount, and the biadical provider will end up receiving the percentage that is left over from that contract. That is all you need to know. Biadical settlement is a third party owner. They buy a policy at a discounted rate. They give you a certain amount of money up front. You sell your policy. The biadical settlement company will continue to pay the premiums, and when you pass away, they will collect the benefit. All you need to know. Life settlement. This term, life settlement, refers to financial transactions in which a owner of a life insurance policy sells a life insurance policy to a third party for some form of compensation, usually cash. A life settlement would require an absolute assignment. Absolute assignment is transfer of all rights of the policy. So remember, assignment. Policy owners may choose to sell their policy because they feel no longer they need their coverage, or premium costs have grown too high to justify the continuation of a policy. In many cases, however, life settlement transactions are offered to senior citizens who may have life-threatening illnesses or short life expectancy. In these situations, the owner may sell their policy for a life settlement provider for an amount greater than they would receive if they surrender the policy. Do you understand that, Jason?
Kind of, but no, I don't.
Very simple, Jason. So a senior citizen is about to pass away. They have life-threatening illnesses, or their policy has gotten too expensive. So a life settlement company, a biadical settlement company also, just like this one over here. But a life settlement company says, hey, listen, so let's just read this example right here. A person age 70 owns a $1 million life insurance policy. He recently sold his business for $5 million, and he decides he no longer needs life insurance. The cash value of the policy is $390 with the life insurance company, which gives the policy owner, if he cashed out the policy, the life settlement may provide him, after reviewing his medical records, $575,000. Once ownership is transferred, the policy owner will receive these funds, and the life settlement company will assume premiums paid until the insured dies, in which the life settlement contract will receive the $1 million. That's pretty simple. You see that? That's what life settlement. The only thing you need to know, the only thing they're really going to test you on is definitions. A life settlement company comes in, buys your policy for a cheaper amount, and they're gonna bank on the back end. Definitions you need to know. Let's see. Let's go through here right quick. Because life settlements are not involved in establishing a new life insurance coverage, the Life Settlement Act defines certain conflict of sale of the original life insurance contract, what accurately identifies the distinction of life insurance settlement businesses. Some of the most important definitions are as follows. Okay, these are definitions you want to come back and review. The term business of life settlement refers to any activity relating to solicitation or sale of life settlement contracts to a third party who has no insurable interest in the insured. You're rarely going to see this. You're rarely going to see this. The owner refers to the owner of a life insurance policy who seeks to enter a life settlement contract. The term does not include an insurance provider, a qualified institution, institutional buyer, a financial entity, and a special purpose entity or related provider trust. Only thing you really need to know about this, guys, are the definitions of life settlements. Life expectancy is the important concept in which the contract, it refers to the calculation based off of the average number of months the insured is projected to live due to medical history or mortality factors. Life settlement contract establishes the terms in which life settlement providers will pay compensation to policy owners in return for the assignment, transfer, sale, or release of any portion. And these benefits in this is the death benefit, policy owner, any beneficial interest in a trust or entity that owns the policy. That's all I'm going to cover on life settlement, because you're not going to see a lot of that. You will see a lot of this. Okay, so I want you to write group insurance. I'm going to give you the bullet points on this. Group insurance is insurance provided through an employer. So group life policies, group life contracts, that is insurance and offered by the job. I'm going to read this and then I'm going to give you the bullet points. In contrast to individual life insurance, which is written on a single life and in which is rate and coverage are based upon the individual underwriting, group life insurance is issued through a sponsoring organization and covers more than one individual. So group of life insurance, write this down. Group life covers more than one life. It is an employer-sponsored plan. It is usually written as annual renewable term. And the two features that distinguish group insurance are evidence of insurability is not required. So what you want to write is group insurance, no medical questions is involved unless you enroll for coverage outside the normal enrollment period. So I'm just going to repeat that. Group life insurance does not require evidence of insurability unless you enroll outside the enrollment period. And then participants, which is the insureds under the plan, do not receive a policy. So when you have a group life policy, they do not give you a policy. They give you what is called a certificate of insurance, which is just proof that you have some type of coverage. So repeat that again. The individuals or the participants in a group plan do not get a policy. They get a certificate of insurance, and the employer, who is the owner of the policy, gets the master policy or master contract. That is really all you need to know about group life insurance. There might be a couple other things in here that I'll add here. Okay, so yeah, I'm going to go into some things about, let me just make sure I cover this. So a couple other things that we're going to need to talk about group life insurance is that if you leave the job or you get fired or whatever happens, you can convert the policy within 31 days after termination. And you will not have to go through any evidence of insurability, so you don't have to provide any new medical records, but your rate will increase based off of you're taking over the policy yourself and the employer is not paying the premiums. And that policy will be converted to a permanent policy. It will not be a term policy. Your policy will be converted to a permanent policy. So I want to cover something up here on the very top, right? So group life insurance underwriting differs. The purpose of the nature of the group is created for the purpose to obtain insurance, okay? So Jason, one thing you have to know is that a group or a job cannot form a group just for the purpose of obtaining insurance. So you can't just go start a job just to get group insurance. There actually has to be a reason why you have a group. That's something you want to know. You cannot, that's an easy question to get right. You cannot create a group just for the reason to obtain insurance. Size of the group. The larger the number of people in a group, the more accurate the projections of future loss experience. And this base is on the law of large numbers, similar risk. Turnover of the group. From underwriting perspectives, a group should have a steady turnover. Younger, lower risk employees enter the group and older, higher risk employees leave. Of course they do that. Financial strength of the group. Because group insurance are costly administered, the underwriter should consider whether or not the group has financial resources to pay the premiums or whether it will be renewable coverage. That's just for me to read to you guys. You really don't need to know a lot of that stuff for the exam. Okay, this part right here, you do need to know. When converting to group life insurance, evidence of insurability is not required, but contributory versus non-contributory. So this right here just says, out of the group plan, am I paying any as the employee, or is the employer going to pay all of it? So the employer or other group sponsored must pay all the premiums or share premiums with the employees. When the employer pays all the premiums, the plan is referred to non-contributory. So you're going to write this down, Jason. When the employer pays everything, it's called non-contributory. And that requires 100% of employees' eligibility to be included in the plan. So 3 things. Non-contributory requires that employer pays everything, and it requires 100% of eligible employees to be included in a plan. The next one, contributory, is when premiums for a group insurance plan are shared with employees and employers. And this is known as contributory, where it requires 75% of eligibility with employees. So contributory is where employees and employers share the cost, and it requires 75% of eligibility of employees be included in the plan. That is all you need to know about group life insurance. You might see something later in this chapter where it says when an employer pays part of the premiums for your employee benefits, those are tax deductions for the employer, not the employee. So when the employer pays your premiums, they're getting a tax write-off of that. That's generally why the employers do it. So they save money on taxes. So qualified versus non-qualified. These are the different type of retirement accounts. You will see this on the exam. You're going to see a lot more definition versus concepts, okay? So I'm going to go through this and I'm going to come back and give you what I write on my cheat sheet that will allow you to kind of simplify this, okay? So an employer-sponsored qualified plan is approved by the IRS, which gives the employer and employee benefits such as deductible contributions and tax-deferred growth. Qualified plans, I'm going to just read this to you. You want to go back and actually understand what a qualified plan is. The qualified plan is where the IRS regulates it. So you have certain tax benefits. The plans are permanent. They have a vesting requirement, which means the employee must be there for a period of time. a qualified plan cannot be they cannot discriminate who can participate in the plan. Use of the benefits or contributions formula cannot be discriminated in any factor. And generally qualified plans are regulated by the IRS, so they get certain tax benefits. Again, I will cover this in more detail. This is actually a really good breakdown right here. You actually might want to write this one down and draw this out right here. I'm going to go over it, but you might want to come back and actually write this down, take a photo of it, and memorize it. Qualified plans versus non-qualified. Well, non-qualified plans are not subject to requiring such as participation, discrimination, or vesting plans. So non-qualified accounts are not regulated by the IRS, so they don't get any certain tax benefits. You do have to pay taxes on the growth pretty often, and they can discriminate. So they can tell you if they want you part of their plan or not. This can be like such as profit sharing plans or special bonuses the company wants to give to their top employees and not to their other workers. So real quickly, qualified plans. Contributions are tax deductible. They are tax deductible to the employee. Plans are approved by the IRS. They cannot discriminate. Earnings on a qualified plan are tax deferred. And all tax deferred means, Jason, is you just pay taxes on it when you withdraw it at retirement. All withdrawals are taxed. Non-qualified plans, contributions are not tax deductible, so meaning you don't get the right taxes off on this. Plans do not need IRS approval, can discriminate. Earnings grow tax deferred unless you pull out of it. Excess over cost basis is taxed. So if you put a certain amount into it, they're going to lose its tax benefits. IRAs. So I'm going to give you the simple things you need to write down for the IRAs, guys. Ready? I'm going to explain it and I'm going to come back and give it to you. An IRA stands for individual retirement account. These can only be contributed to from earned income. So you can only add into a IRA if it is earned income, money from a salary, commissions, job. You can put up to $6,000 a year away into this plan, tax deferred growth. So if you are under the age of 50, you could put $6,000 away. If you are over the age 50, you can put $6,500 away. Forgive me, that might be $7,500. Hey Siri, what's the new regulations for the catch-up period for IRA contributions?
Okay, I found this on the web for what's the new regulations for the catch-up for IRA.
Yeah, no, I had it right. Okay, so it's $6,500 for over 50 years old. So there's something called the catch-up period. If you're over 50, you can put $6,500 a year away. And if you're under 50, you can put $6,000 a year away into an IRA. Now, let me tell you what's special about an IRA. An IRA used to be so popular that you could put money away today, invest it, and whatever it grows into, you just pay taxes on it when you withdraw from it at the age of whatever age you pull out of it. Now, I want to give you this. If you do not start withdrawing money from your IRA, Jason, by 70 and a half, they will tax you or penalize you 50% of your money. So in an IRA, if you're 70 and a half, and let's just say you have $1 million in the account and you haven't started withdrawing from it, the IRS, after 70 and a half, they're going to penalize 50% of that. So they're going to take $500,000 right out your pocket. I don't know if that's ever happened, but IRAs came into place years ago. And there's new retirement accounts that are better than IRA in this example. But you must start withdrawing from these accounts. Otherwise, they will hit you with that 50%. by 70.5. Now, there's a law that you need to know about the IRS. If you pull out before that, if you start withdrawing from these accounts before 59.5, the IRS will hit you with a 10% tax penalty. So you cannot withdraw from these accounts before 59.5. And they do that to incentivize you. Hey, leave the money in there, let it continue to grow. If you pull any money out before 59.5, they're going to hit you with 10% tax penalty. Then there's something called the Roth IRA. So the traditional IRA, your money is tax deferred. So the money that you pay taxes on, you pay it at retirement. And a Roth IRA, it works exactly how the other one works, is you can max it out at $6,000 a year, or the catch up period is $6,500. But the Roth IRA, your money is grown tax free. So you already pay taxes on it before you invest it. And again, I'll break that down for you, but any earned income on that is tax free. Traditional IRAs and IRAs are earned income only. Contributions with traditional IRAs are pre-tax dollars. Of course, we just said that. So there's a whole lot of other stuff that you guys can come back here and just read this stuff right here. But for the most part, what I've given you about IRAs is what you want to know. There's a couple penalties in here you might want to come back to. The following taxation applies. If you over contribute to an IRA, they're subject to 6% tax penalty. Okay, rollovers. Rollovers is when you leave one job. So let's just say you have a 401k at a job. It is wise to not leave it at the job. What you want to do is you want to transfer it over to another financial institution, or you can roll it over into another 401k. So when you say rollover, all you're doing is transferring funds from one qualified account to another. You're not cashing the money out. You're just going to roll over a tax-free distribution. So you take the money from company A to company B without owing any taxes. Plans from employers. So there is something called the self-employment plans, also called the HR-10, or also called KEO plans. All these words mean the exact same thing. This just says that a self-employed person can put money away, tax deferred, for a certain period of time. I'm going to read through this just so I make sure I don't miss anything. These plans allow self-employed individuals to fund their retirement program with pre-tax dollars, as if a corporate retirement plan or pensions. To be covered under the KEO plan, a person must be self-employed or partner of a program, part-time or full-time, and owns at least 10% of the business. So that HR-10, that 10 stands, you must have 10% ownership in the business. Contributions are lesser of an established dollar limit, or 100% of their total earnings. The contributions are tax deductible and accumulate tax deferred until withdrawals. So this works just like any other non-qualified account. Upon participant's death, payouts can be available immediately if the participant becomes disabled or he or she collects benefits immediately. The funds can be left to accumulate. When the participant enters retirement, distributions must occur no earlier than 59.5 or no later than age 72. If withdrawals before 59.5, again, you hit with a 10% tax penalty. At any time, payments can be discontinued with no penalty, and funds can be left to accumulate. Under eligibility requirements, any individual who is at least 21 years of age has worked self-employed pensions for 1 year or more and works at least 1,000 hours per year full-time must be included in the KEO plan. The employer must contribute the same percentage of funds that the employee retirement accounts he or she accumulates. I will come back and simplify this a little bit later on our book piece. Simplified employee pension plans. This is nothing more than what we call a SEP IRA. When you guys get your investment license, you will absolutely love this for your clients. This is an account that if somebody does not qualify for an IRA because they make too much money, they are able to open up a SEP IRA, which they can put 25% of their earnings away, tax deferred. So you can put up to 25% of your money or away a year. Simple plans, savings and incentive match plans for employees is available to small businesses that employs more than 100 employees. So a simple plan says that you have no more than 100 employees who receive at least 5,000 of compensation from the employer during the previous year. To establish a simple plan, the employer must not have a qualified plan already in place. Employees who elect to participate may defer their specified amount each year. Employer then makes some matching contributions, dollar for dollar, to the amount of 3% of equal compensation tax deferred. Again, I'm going to break this stuff down for you. Profit sharing 401k plans. Profit sharings is generally when a company has profit, they will give you a certain amount of percentage to share with their employees. As simple as that. 401k, that is just an employee sponsored plan. Let's see if there's any specific numbers in there that we need to know. That's just another amount. Again, you can max out, or sorry, your employer can match you. 403b, this is what is called a tax sheltered annuity, also called a TSA. These are normally used for nurses, doctors, ministers, teachers, anyone that's part of a nonprofit organization or school public system. 403b is just another name for 401k. That is what the tax code is written. Nothing special about the names. They work exactly the same. We do have a chart here that does go over what the employee plans look like and who can contribute and who is eligible. Life insurance needs and suitability. Okay, so we're going to talk about real quickly how do we determine how much life insurance someone needs, who needs life insurance, what are the purpose for life insurance. This is what this is for. This is very simple, okay? Life insurance is called survivor protection. I'm going to simplify these. Survivor protection is nothing more than life insurance. That's why someone needs life insurance. The other reason for life insurance could be called cash accumulation, because some insurance companies will sell life insurance as a savings vehicle. People say, hey, you can use life insurance for cash accumulation. Liquidity. As a result of cash accumulation, some life insurance companies provide liquidity. That means you could pull money from the cash value at any time and can be used for immediate needs. Estate creation. When the moment you get a life insurance policy in place, you create an immediate estate, meaning if you pass away, your family immediately inherits a certain amount of money pending the life insurance policy paying out. Another way for life insurance use is called estate conservation. Sometimes people buy life insurance to pay off taxes. If you have a large inheritance, there's something called inheritance tax and state tax and federal taxes. So you'll inherit the properties and the assets, but you use the life insurance to cover any of those needs, any of those taxes. So you don't come out of pocket for those. Those are the reasons for life insurance. You want to know these. These are very simple, easy questions to get right. So if you were to write down, why do people need life insurance? Survivor protection, cash accumulation, liquidity, estate creation, and estate conservation. Another way for business, for life insurance, is called business needs. And this is also what, in some businesses, if you have 2 partners or 3 partners in business, if one person was to pass away, you want to make sure you have life insurance to not only cover the expenses or cover any training, but you also want to pay off the family that would inherit the business. So I'll give you an example. Let's just say, Jason, you and I go into business together and we open up a mechanic shop. If you and I are both 50-50 owners, and if our spouses are not involved in the business and something happens to either one of us, you don't want the other spouse coming in the next day trying to run the business with you, right? They were never making the business decisions. So you take out a life insurance policy out on myself, and you just use that money to pay them off to buy that part of the business. So now the business is 100% yours. So that's where life insurance company comes into place with business needs. You would generally enter a contract, which is called buy-sell agreement. Buy-sell agreement is a contract that is funded using life insurance. You'll see that later in the studies. The other types of way you will use life insurance in a company is called key person insurance. This is when a company, let's just say you are a huge executive in your company and they cannot operate without you. Well, the insurance company will take out called a key person policy on you. It can be any type of insurance. It can be permanent or term. And if you pass away, the company will receive the death benefit, not your family, but the company. And they'll use that policy to cover any training, cover any expenses, cover any profit loss, because now they have to use that money to go replace you. Does that make sense? And remember, that money does not go to your family. That money goes to the business. When you have a key person policy, the business cannot use tax deductions as an expense of the premiums. However, if the key person dies, the benefits of the business are received tax-free. No special agreements or contract are needed, except that the employee would be given permission for this coverage, or must give permission. So let's talk about buy-sell fund. Okay, we were just talking about this. So buy-sell agreement is a contract that determines what will be done in the business in the event if that the owner dies or becomes disabled. This is called a business continuation agreement. There are several types of buy-sell agreements that can be used between partnerships and corporations: cross purchase, entity purchase, stock redemption. You want to come back and actually read those on your own, guys. You might see these on the exam, so might as well for you guys to come back and read those. Tax treatment for life insurance proceeds. Understand this, okay? You ready? Life insurance death benefit are tax-free. You do not owe any money when you receive an insurance check. There's no money owed. Dividends. I talked about dividends on chapter 3 yesterday. Let's see. Policy loans. Okay, this is good to know. If you take out, a policy owner may borrow money from their cash value. Money borrowed from the cash value is not income taxable. However, if the insurance company charges interest on outstanding loans, policy loans and interest can be repaid in any of the following ways: by the owner while the policy is enforced, at policy surrendered, or at the insured's death, subtracted the death benefit. I'll go into detail on that at another time. Policy loans from cash value are not tax income. So if you borrow money from your cash value policy, the money is not taxable. Let's see, surrenders. When a policy owner surrenders a policy, some of the cash value received may be taxable as income if the cash surrender exceeds the premium. I covered that in the previous chapter, that if your cash value exceeds any money you paid into the policy, you've earned money, which is obviously subject to income taxes. An example here is that if your face amount is $300,000 and you paid $70,000 into the policy, but the cash value is $100,000, well, there's a $70,000 difference there. which means, Jason, you would owe $30,000. You would owe taxes on that $30,000 gross. Does that make sense? But if it was the opposite, if you paid 100,000 and you only owed 70, you don't owe anything because you paid more than what you had in the account. Accelerated benefits, meaning if you sold your policy to somebody else, or I'm sorry, if you enter the accelerated benefits such as the terminal illness rider, those benefits are paid tax-free. Settlement options, let's see, settlement options, when the beneficiary receives payments consisting both principal and interest, the interest portion of payments is taxable. For example, if 100,000 of life insurance proceeds were used in a settlement option, paying 13,000 a year for 10 years, 10,000 per year would be income tax-free, and 3,000 will be paid per year income taxable. Group life, family life, okay. Okay, so this is what I was telling you. This is what I was talking about earlier. Okay, guys. So, if an employer is paying for your policy, those premiums are tax deductible to the business up to 50,000. If the premiums, no, up to 50,000 of coverage, not 50,000 premium. If the coverage exceeds 50,000, the employee will have to pay some of the premiums. So up to 50,000 of coverage is tax deductible for the business. Let's see, modified endowment contracts. Just write this down. You might see this on the exam once or twice. Modified endowment contracts, another word for MEC. This is a whole life policy that you usually overfund the policy. And if the account performs like very, very well, it will lose certain tax benefits. So I'm just going to read this just for my own understanding too, and for you guys. Following the elimination of traditional tax shelters by the tax reform in 1984, single premium life insurance remained as one of new financial product offering significant tax advantages. Consequently, most of these types of policies were purchased solely for the purposes of setting aside a large sum of money for tax deferred growth, as well as a tax-free cash flow available via policy loans or partial surrenders. To curb this activity and determine if the insurance policy is overfunded, the IRS established what is known as the 7-pay test. Okay, so MEC, MEC, modified endowment contract, make sure you put the 7-year pay test. Any life insurance policy that fails the 7-year pay test is classified as the MEC and loses standard tax benefits of an insurance contract. And a MEC is accumulated premiums paid during the first 7 years of the policy exceeds the total amount net level premiums that would be required to pay the policy up using guaranteed mortality costs and interest. Keep this simple. MEC, if it fails the 7-year pay test, it loses certain tax benefits. That's all you need to know. So MEC is an overfunded life insurance policy and fails a 7-year pay test. Once a MEC is always a MEC. That, let's see. Okay, this is a big one. Social Security. So I'm going to simplify Social Security, okay? The name for Social Security is named as Old Age Survivors Disability Insurance. So Social Security was designed back in 1935 to help provide workers, just in case they became sick, they became disabled, or if a loved one passed away, that they would still have money coming in, okay? So if a person is to receive Social Security, they must be what is called fully insured. So to qualify for Social Security, you must be known as called fully insured. And that is someone that has 40 quarters of coverage, which is equivalent to 10 years of work. Meaning if you paid into a Social Security, you've worked a job for 10 years, then you're fully covered. You probably won't see anything about Medicare. I don't remember seeing anything. What you will see, an individual can obtain currently insured or partially insured if he or she has 6 credits during a 13-quarter period. Meaning if you're partially covered, write 6 credits. That just means, Jason, don't get overwhelmed with that. That just means, hey, you worked for a period of time. If you become disabled and you didn't hit 40 hours, you'll receive partial disability. Now, the 3 ways someone will receive Social Security is if a spouse or their parent dies. So if a husband or wife and older, let's just call it someone's grandparents. If the grandfather passed away, the grandmother will receive the Social Security benefits. Or if mom and dad passes away and there's children, the children will receive the Social Security benefits until that person reaches the age of 18. Second way to receive Social Security is they become disabled. So if you've ever heard someone, hey, listen, I'm on Social Security because I'm disabled. That's the second reason or second way. And then the third way is if someone obviously they hit the age of 62 or 66 years old is when you can receive Social Security benefits. Survivor protection, okay. And you guys obviously should come back and read this in full detail, but I'm giving you the bullet points for that chapter. And that's pretty much, guys, what you need to know for this chapter. What I'm gonna do now, guys, I'm gonna move over to the cheat sheet on my side over here and give you the rundown of those retirement accounts. You will see retirement accounts on your test, but let's not get overwhelmed. I'm going to simplify this stuff for you. Oh. All right, am I writing on this? Hopefully, can y'all see this on my board?
You drawing?
I'm trying to draw.
I mean, I don't see anything happening on my screen. Only a little.
Give me a second. All right, I'm going to pause the recording and charge my stuff right quick and just come back to this.